On this episode of the HyperFast Wealth Show, I interview Marco Santarelli. He bought his first property, his first investment property at age 18. Since then, he's gone on to build a portfolio of hundreds of rental homes, and he's helped other people do the same. He's also educated thousands. Welcome to the show, Marco. Recording. All right, I'm excited to have you on the show today, Marco. Thank you for being here. We've got a ton of great stuff to talk about, and you bring such a breadth and depth of knowledge in real estate investing and using that really as the vehicle to create wealth. And today I know we're going to get into a lot about different ways to create wealth through real estate, what you're doing to educate people on the topic, and a whole bunch of other stuff. So welcome and thanks for being here today.
Thank you, Dan. I really appreciate being on your show. I'm excited to have a conversation with you and hopefully educate your listeners.
Yeah, I'm excited about it. And before we jump in, can you just give the listeners a little bit of a sense of your background and how you got into real estate? I know you started really young, and what that progression has been like.
Yeah, thanks, Dan. So yeah, my story is a kind of somewhat unusual. I just knew at a very early age, probably my early teens, that I wanted to be financially free. I just knew that wealth was the direction I wanted to go. And even though I went to university and got a degree in criminology of all things, I always had the entrepreneurial bug, and I knew that I wanted to be in business and create value by helping other people in business. And I started off with real estate and then left it and then ultimately came back to it. But people ask me, well, hey, how did you get involved in real estate? Well, my answer is I bought my first rental when I turned 18 years old. Why? Because I could qualify for financing. So I had a part-time job at the age of 16. And I saved up enough money to put that towards a down payment. And that's where they say the writing was on the wall. That first rental led to another rental. And then I got my real estate license. I don't remember how old I was, but I was probably around the age of 20. And I started selling residential real estate and doing what your audience does. We're driving people around in the backseat of our cars, showing them houses, opening doors, trying to get listings. That's just how you made that business work. But that's how I got started in real estate. And, if you fast forward, I just went through trials and tribulations of starting other businesses and failing in other businesses, and then ultimately coming full circle back to real estate on a full-time basis.
Yeah. What an amazing start. I mean, 18 and you got your first rental. It sounds like you were planning for that as early as 16. Is that right? With the job and saving money? Like, did you know you were going to go that route?
An interesting thing happened. I think I was probably 9 or 10 when it dawned on me that I felt inside I was an entrepreneur and I wanted to pursue the world of investing and creating wealth. And I didn't know how I was going to do it. But as a teen, before I could even drive, I would beg my parents to drive me to the bookstore or to other stores to pick up books, tapes. Back then, yeah, literally they were cassette tapes. They weren't CDs or anything else. But I was that nerdy kid that was ordering Tony Robbins' Personal Power, Jim Rohn audiobooks, Zig Ziglar, all the greats from the real estate sales era, Tommy Hopkins and all that kind of stuff. I mean, I was gobbling up all that personal development and personal education stuff. Yeah, I was a weird kid, but I was just focused on not, maybe dating or playing with, like the toys that we play with. I was focused on personal development and educating myself and learning what I need to learn to be a good salesperson, a good business person, a good entrepreneur, a good investor. And so by the time I was 16, I probably knew more about real estate investing than I'd say 90% of adults. And I just couldn't invest yet. I had to wait until I was 18 to do it.
Wow. That's exciting to hear, a story of someone who had the drive and the passion to really learn and really better yourself at such an early age. So my hat's off to you for that. And, if we got any young listeners out there, you're never too young to start.
No, exactly. And yeah, like to your young listeners, I wrote these 10 rules of successful real estate investing, and it's published on both of our websites. It's the first thing you see. And my first rule is to educate yourself. It's such a critically important function in being successful, because you can't expect to be very successful in business or in real estate if you don't invest in yourself first. And knowledge is so critically important. It can take you from being just an average person to a good investor, and from a good investor to becoming a great investor. And when you take all that knowledge and you put it to work, you can create passive streams of income for yourself and for your family and for your heirs and generations to come. And think about, the legacy you could leave and the role model you could become as a father or a husband or an investor, just by taking the time to educate yourself. And a lot of people don't do this. They kind of look for the magic bullet or the fast track or the hack or the cheat. But at the end of the day, you have to invest in yourself and build your knowledge. It's the only way to get ahead and competently.
Where do you think, now the kind of the follow on to that would be, and I agree, you gotta educate yourself going into the process or whatever venture you're going to get into. How do you bridge the gap from education to execution? Because at some point you got to learn by doing, right?
Yeah, that's a good question, Dan. A lot of people fall into the trap of analysis paralysis. They think they need to overthink and analyze things to death before they feel the confidence to move forward. So that's one trap. The other trap is believing that you need to continually educate yourself to the point where you are an absolute expert and you've built up enough confidence to take the next step, to take actions, to pull the trigger and make things happen. The reality is a lot of people overthink that, and they think that they need to know a lot more than they actually do. When the reality is you just need to start with a foundation of education, of knowledge, and you can do that by reading probably 2 or 3 books on real estate investing, and or listening to a selection of podcasts like yours right here. Once you have that foundational knowledge built, and some of the questions you need to ask, then the next step, and this is the launch pad, is to start building the team of people around you that's going to help you and support you, because this is a team sport. You're not going to do it by yourself. You have to have a team around you, and that includes your acquisitions person. Now, if you're a real estate agent or real estate broker and you have access to deals because you happen to be lucky and you're in the right market where the numbers make sense, great. You are your acquisitions person, or maybe you partner with someone, you become the acquisitions team. Then you have your property management company or your property manager. You have your lender or mortgage brokers that will help you with the financing. You have your asset protection attorney. You have your tax advisor or CPA, your title company, et cetera, et cetera. So you build a team around you that will support you, and they will be able to ask questions that you may not think about. But you don't need to know everything. You do need to educate yourself. And the thing is education never ends. You can start and you continually educate yourself, but you should always be a lifelong student. Like I've been on 2 cruises with Robert Kiyosaki, and it's very smart guy, very successful investor. But if you look at Robert Kiyosaki, as successful as he is, he owns probably close to 2,000 units of residential real estate. He's always at the back of the room with a notebook, writing down notes, listening to whoever's speaking, even if he's heard the stuff before and he knows it probably better than the presenter. He's always listening and learning and looking for the next thing that he hears that he didn't know, or maybe he knew and forgot about and needed that kick in the butt. So be a lifelong student, be a perpetual learner, and don't think that you need to know everything to get started, because if you think that, guess what? You're probably not going to start ever or very late in life.
Yeah, that's a great observation about Robert Kiyosaki, who, in case anyone doesn't know, he is the guy who wrote Rich Dad, Poor Dad, and one of the icons when it comes to real estate investing. And I I saw Tony Robbins actually do the same thing at an event that my wife and I were at a few years ago. There was a guest speaker was up there, and he was just ferociously taking notes in a notepad. Like I've never seen someone write as fast as he was. And this was like his one time not on stage for like 12 hours that day. And he must have filled like 30 pages of notes, just like insanely like consuming the information, you know, being taught by this guest speaker. So that's a great observation on Robert Kiyosaki, that like even when you're at the top of the food chain, the top of, you know, your game, there's still an opportunity to learn from other people.
Always. That's a key point, Dan. You hit the nail on the head. No matter how much you know, there's always more that you could know if you want to learn. First of all, you know, knowledge is endless. And second, you don't know what you don't know. So based on that, if you just are open-minded, you keep your eyes open, your ears open, you will always find new ways to do what you're doing better. Or if you look around, you'll find new opportunities open up to you. But if you're not aware and you're not open to new information and learning, these opportunities will be there, but you won't recognize it. You won't see it.
Yeah, I agree. And I like the point you made about building the team around you. And you listed like 6 or 7 examples. And you don't have to become an expert in every part of the process in every area. And if you do, at some point, you're going to be holding yourself back in your ability to grow. So can we talk for a little bit about how you went from the you know, self-educated teenager who bought a rental property? Like, how did you get from there to where you are now with the team in place, you know, several multifamily properties, educating other investors? Like how did you start that scaling process and build out the team that you currently have?
So an interesting thing happened in 2003. This was kind of the turning point. You know how there's different events that happen in everybody's life that takes them on a completely new trajectory. I had come out of a dot-com failure. I was a third co-founder in a dot-com business back in 1998. And we had 105 employees and raised $9.5 million in venture capital funding. And then when the NASDAQ crashed, we were not cash flow positive, as were many companies at that time. You know, remember pets.com and companies like that. I mean, these were all companies doomed to fail because they just didn't have a sustainable business model. But when the NASDAQ crashed, we had to fold the company down. It took about a year, and I was the third last person to leave. But you know, coming out of that, I didn't want to go back into corporate America. I didn't want to go back into real estate sales. I didn't want to have a job, like a job. I knew I was an entrepreneur, and I had to find my way. And so I took some time off. I had the, you know, fortunate luxury of being able to do that for a period of time. And I got this email in the middle of 2003 from someone who you might recognize, or if you're in the real estate investing space, you might recognize a guy named Robert G. Allen. And he wrote about 20 books, but he's well known for his book, Road to Wealth and Nothing Down. You know, he was one of the godfathers of Nothing Down real estate. I don't know how I got on that list, but I got an email in the middle of 2003 and said, hey, we're having this free 3-day seminar training boot camp type of thing in Orange, California. So I thought, well, I love real estate. I have time on my hands, and it's coming up in September, so I'm going to go. So I went, and this was an amazing 3-day event. The speaker was incredibly knowledgeable, and he had you riveted to your seat. You wouldn't get up to go to the restroom until the break because he was just that good. But what was interesting is there was about 2,000 people in this ballroom. And towards the end of the first day, and of course over the next 2 days, they were offering these $15,000, $25,000, and $35,000 boot camps on real estate education around the country. So you'd fly around to these different cities to attend these different boot camps to learn everything from wholesaling to fixing, flipping, and rehabbing and all kinds of stuff. So anyway, I whipped out my credit card, went to the back of the room, signed up, and 2 major things happened from my decision to do that. Number one, it kicked me in the pants to get back into real estate investing full time. And I lit the ground on fire. So in 9 months from that point forward, starting in January of 2004, I had purchased 84 doors, mostly single family homes and duplexes, 84 units in a 9-month period. In tandem with that, investors were coming to me early on saying, hey, we're getting the same education and I see what you're doing, but can you help me? Could you mentor me? Could you coach me? And my answer was always no, no, and no, because I didn't have the time nor the interest to, do one-on-one mentoring and coaching. But I said, hey, what I can do is I look at a lot of deals and I see a lot of deal flow and I underwrite a lot of deals that I'm not buying. I can assign them over to you. And that was how the business was born. The current business here at Norada Real Estate Investments is I saw a need, identified a need where people were spending the time and money to educate themselves, but still weren't pulling the trigger. They still didn't know enough or have the confidence to actually take action and identify the properties, analyze them, and put them under contract. So I said, well, here, I'll do a lot of that due diligence for you, wrap it in a bow and present them to you, and you can just purchase these turnkey investments right from me. And that's how the business was born. So that's how I transitioned from doing whatever I was doing to getting back into real estate and being able to help other people.
Why do you think other people went to the same classes, boot camps as you, consumed the same information, but you were able to go out and execute at a high level and they struggled? Like, what do you think the difference is there?
And that's the $1 million question. I'm not sure I actually know the specific answer to that, but I have 2 guesses. Number one, I think people do like a done with you solution where they want to learn, they want to understand, and they want to participate, but they don't feel confident enough to do it all on their own. And so they want someone to come to them saying, here, I've got 70-80% of the solution done for you. We've done this research, we've vetted the providers and all this, the people that you're going to be working with. We've cherry picked all these properties. These are ideal investment properties. So here's 80% of it, and we're going to help you do the due diligence and finish the last 20% and basically cross the finish line with it. I think a lot of people want that hand-holding and solution. It's no different than someone saying, well, hey, why don't you invest in the stock market directly? Why are you working with, a stockbroker or a wealth advisor or a tax advisor or an investment advisor? It's the same reason. They could do it on their own, but they're willing or wanting to lean on someone else's expertise that has already been there, done that, bought the t-shirt, and has a level of success. So I think that's the number one reason. The number 2 reason is that I think people always have an element of fear, saying, wow, this is real estate. It's not a low ticket item. I don't want to make a mistake. And I'm not exactly sure I know what I'm doing, even though I've read like 14 books. So I think the combination of those 2 things is what keeps us in business. And we're on our 16th year, and, we do a lot of transactions. So. And
are you sourcing the deals right now or back then and then assign them out, or do you close on them and then resell them, or like what's the business model look like for people that might be interested in getting properties from you?
Smart question. So we do our model. We are a real estate brokerage, so our model is a brokerage much like a traditional real estate brokerage. However, we have you, the investor buyer, as our client in one hand, and on the other hand, we're dealing directly with our relationships in the 22 markets that we're in, and these are typically new home builders and professional large-scale property renovators, rehabbers. So they are the sellers, and they provide us the inventory. So we work directly with the sellers in one hand and directly with our client investors or buyers, if you will, in the other hand. So think of us as the hub of wheel. And every spoke is somebody that you will need that we vetted, such as mortgage brokers that do nothing but non-owner occupied loans, 1031 exchange companies, title companies, inspectors, et cetera, et cetera. And so it's very much like traditional real estate. Our compensation comes from the sales side of the transaction, just like it does in traditional real estate. So that's why we can provide our services at no cost to the investor, the buyer, that we work with, because we're compensated on the sales side, and we can provide lots of free education and value to you and counseling on the buy side.
And are you mostly single families now, or what's the investment mix look like, or the deal mix look like?
Right. The mix is 80% single family homes because that just happens to be the most abundant property type in the United States, and it's easily found, easy to work with, easy to understand, easy to buy, and easy to sell in terms of, within the context of real estate. The other 20% is made up of duplexes and fourplexes, and those are often new construction just because the environment we have in the United States right now, it's very hard to find, well, even for multi-units, I'm sure you're probably discovering this on your own, but even with small to medium-sized multi-unit properties, it's very competitive. Everybody's chasing after them. They're not overly abundant, so they're much harder to find. So the single families by far is the most widely available unit type available. So that's what 80% of our sales are.
And is there a certain type of single family home that you focus on or go after? Or like, I know you said you're in 22 markets, but like what kind of numbers are you looking for on these, and what's the typical single family home deal look like?
Yeah, so that's a great question for an investor to ask. And so typically these are 3-bedroom homes. They're anywhere from 1.5 to 2 baths. That's the average of what we have, but they can range from 2 to 4 bedrooms. Now, one question that most investors don't ask is what's the type of neighborhood that it's in. And that's a big factor, an important factor for me, and something we talk about a lot. I talk about that on my podcast. My investment counselors talk to investors about that all the time. We generally stick to what we'll classify as B+, and A- class neighborhoods. Now, the gamut is really from A+ to D, and an F is an absolute fail, but typically Ds are what we refer to as war zones, and every city has its, war zone neighborhoods. It's the place you don't want to be, right? Cs are okay, but we try and avoid C-class neighborhoods for the most part, just because they look great on paper, but the demographic of the tenant that is in a C-class neighborhood is typically a little bit more problematic. You have a little bit more brain damage, or your property manager, I was going to say, is going to be more hands-on. They look better on paper. They have higher capitalization rates, and cash-on-cash returns, but they don't tend to appreciate over time as well as something in an A-class neighborhood. The problem with an A-class neighborhood is that they don't look as good on paper, because the cash flows are very tight, and the cap rates are pretty low, but they tend to appreciate much better and hold their value much better than anything in a C-class neighborhood, and even to a large degree B-class neighborhoods. So what we find is the sweet spot are properties like 3-bedroom, 2-bath homes, detached homes, in your B+, and A- neighborhood. That's the best bang for the buck. It's kind of like the sweet spot between appreciation potential and cash flow and cap rates. So that's what we focus on in the 20 some markets that we're in. I don't know if I answered your question, but that's...
Yeah, it's great. No, you did. Let's couple more. Let's peel the onion back a little bit more. What kind of cap rates are you typically getting on these B and A- properties?
So in 2020, this year we're seeing cap rates range from 6% to 8% as just kind of a general rule of thumb. It really is market specific and neighborhood specific. We'll see cap rates on some properties that are as high as 9%, and sometimes they actually touch 10%. Those are more of the $80,000 to $100,000 properties. But as a rule of thumb, bank on 6 to 8% as a cap rate, and then when you put 20% down and you apply financing or leverage to those properties, you can see those cash-on-cash returns jump up to 8 to 10 to 12%. It really is, again, market specific. And let me give you an example of that. If you look at the 3 markets that we're in Alabama, which is Huntsville, Montgomery, and Birmingham, properties there are going to range from $80,000 to about $140,000, $150,000 for a 3-bedroom home in a B-class neighborhood. Those are going to kick off typically anywhere from 7 to 10% cap rates. And then, with leverage, you're going to have your cash-on-cash returns that are going to be probably 8% and above. But when you look at a market like Jacksonville, or let's say parts of Kansas City, parts of Indianapolis, Chicago, maybe not so much Chicago, you're going to find properties are going to be in the range of about 130 to 180, 130 to 180,000 for, again, a nice, good size 3-bedroom, 2-bath home. However, those are going to be in nice neighborhoods with stronger appreciation potential. They have good stability, but initially they don't look as sexy on paper because you've got lower cap rates and your cash flows are still good. But relatively speaking, they won't outperform the Alabama properties in the first year or two, but over time they will outperform them appreciation and equity wise.
Yeah, no, there's certainly like a lot of variety, and like we see that in our market, like in the really good parts of Arlington and DC, like the cap rates are as low as 4%. And if you get in the outskirts or some other places or up some areas of Baltimore, then you can touch double digits.
Right. So you're experiencing an issue there in your market, like what we have here in Southern California, and what you actually see pretty commonly in much of the coastal markets in the United States. And that is that property values, or price, I should say, property prices have gone up so much that the markets become expensive. They become more unaffordable. The affordability rate drops. And what we find is that prices appreciate faster than the rent. So the rents actually trail behind. And there's this rule of thumb, or this metric we use, it's called the RV ratio, or the rent to value ratio. You could also call it the rent to price ratio. And what that means simply is this. If you have a property that's $100,000, I use that because math is simple. And by the way, we have a lot of $100,000 properties in decent neighborhoods. You ideally want that $100,000 property to rent for $1,000 per month. So that's a 1% RV ratio. If you are in a market where you've got $1 million property, let's say, the DC area, in an ideal world, you want to have that rent for $10,000 a month. Again, 1% of the value or the price.
You're not getting that here.
No, you're not. And my guess is that the market you're in is probably like Southern California. You're about 0.4%, meaning that property will rent for about $4,000 plus or minus $500.
Yeah, probably 4,500 to 5,000, maybe. So yeah. Range.
Yeah, so there you are. You're in that 0.4, 0.5% RV range, so that doesn't work from an investment perspective. And if you do think that you're a smart investor and you're going to buy that even with a 0.5% RV ratio, because you believe you're going to make it up in terms of appreciation, you're going to give up on the cash flow, maybe have negative cash flow, but you're going to make it up on the equity growth through appreciation. Well, then I would call you a speculator. You're borderline a gambler. Because markets do appreciate, and over time they certainly do because of inflation. But the reality is if you're chasing appreciation, if you're hoping the value or the price goes up, it may not, and it might for the next year or two. But the thing is markets are cyclical. They will appreciate and they also depreciate, especially as affordability gets low and or interest rates go up and or the economy suffers because unemployment is increasing. I mean, these are dynamics, macroeconomic factors you cannot control. And so property values change. But if you're banking on your investment being a capital appreciation, a capital gain, such as appreciation, well, then you're speculating. And I don't believe that you should speculate. In fact, my third rule of my 10 rules is to never speculate. You shouldn't be a speculator and chase after appreciation. You will get it. It will come. It happens organically because of inflation. And then, if you're in a high demand market, those drivers of population growth are going to push prices up as well. But don't try to get in when you're late in a cycle and you're not necessarily at a top of a local market cycle, but you're getting there and thinking that you're going to continue to have 2, 3, 4, 5 more years of strong growth or price growth. That may not happen. There's no guarantee of that. So don't be a speculator. Don't gamble in real estate. Invest for cash flow, but intelligently invest so that way you have the cards stacked in your favor to gain the equity as time goes on.
Yeah, no, that's a great point. Like you shouldn't plan on having negative cash flow and hoping that you get the appreciation. And we definitely see that in our market, the price to rent ratio is like you described. And the way we approach investments is like, if we acquire this property, can we improve the value by doing a build or getting more density, or something in it that it's gonna give us the opportunity to take advantage of those higher prices by improving it, because it makes the improvement go up by that much more of a multiple. But if you were gonna if your plan was just to hold it and have negative cash flow while the prices go up, then I think you should probably look at other markets for cash flow or a different strategy.
Right. Yeah. If you want to be an active real estate investor and take the active approach and build value, create value, meaning that you are taking a property over that needs work and you can improve it, or is poorly managed. And this is the case with multifamily units where they are undermanaged or poorly managed, and you can add value, meaning add to the market value of that property by improving the management, by improving the operations, by cutting expenses, by increasing rents. Great. That's a value add approach, and that works very well when you find the right deal. But some people don't have the knowledge or the expertise to do that, and some people don't have the time to do that, so it's really not even an option. The other alternative is to be a passive real estate investor, and be more passive, where you are buying into cash flow in quality property in good neighborhoods that don't need work, but have that cash flow, the rates of return, and the appreciation potential. So that way, over the next year, 2, 3, 5, 7, 10 years, you're gaining the accumulated cash flows plus the equity growth from appreciation, and of course the amortization of the loan. That's a more passive approach. That model works well. It's proven. It works time and time again. It's just buying right properties in the right markets. So both of those models work. It's just you need to ask yourself and be honest with yourself, do I want to be an active real estate investor? Do I want to be a passive real estate investor? And when you make that decision, become an expert at it. Just choose to follow that path and improve yourself, constantly. And you will be very, very successful in a very short period of time.
Yeah, I agree. It's two different approaches, and you gotta focus on your lane. And you brought up management a couple times there, and I think a natural question would be, given that you're a single family guy, and I know tons of people that have crushed it doing the single family model, and I also know some people that have done really well with multifamily, like getting 16 or 30 or even more doors under one building, and they're always touting that they can kind of consolidate the management. So how do you approach the management of having multiple single family homes, either for yourself or for your investors? Like what's your approach to managing a portfolio of single family homes?
So with very few exceptions, we as a company, my team and I, don't recommend that you manage your own properties unless you really know what you're doing. You're seasoned, you know how to deal with people, you understand the tenant landlord laws, you enjoy, dealing with tenants and collecting rents and all that kind of stuff. I'm not saying don't manage your own properties, but 99% of the time you probably won't and shouldn't. And especially if your properties are out of market or out of state, meaning that they're not local to you. I always suggest you focus on your career, your business, spend time with your family, enjoy your hobbies, travel, do all those kinds of things, and not be involved in the month-to-month or day-to-day operations of managing your properties. So what's the solution? How do you manage your properties? The answer is pretty simple. In any market, particularly medium to large size markets, you're going to have many, if not dozens, of professional, full-service local property management companies. And that's exactly how we do it. I mean, we'll have 2 to 3 professional full-service property management companies in all the markets that we operate in. Every property that we sell is tied to one of those management companies. So they're already under management, and often they're already leased, cash flowing, performing, and under management. So you're just taking over a performing asset. But if you've got a portfolio of properties where you're just getting started and you're building that up, then what you do is you find yourself, do your due diligence and vet the property managers in the market you're investing in, and put your properties under management with one of those highly recommended, sourced management companies. There's many of them out there. You just have to do a little bit of due diligence, but let the professionals do it. I call property management a thankless job. Do you really want to be doing property management? More often than not, you don't. And at the end of the day, that 8%, 9%, 10% is a cost of doing business. It's already baked into the cake. You've already forecasted and budgeted for it. It's just one of your operating expenses. So if you're trying to be cheap and save that, well, you might be very short-sighted. You might be taking on more work, especially if you value yourself at more than that 8, 9, 10% you're paying your property manager. If your time is worth $100 an hour, $500 an hour, whatever you value yourself at, well, it's a lot cheaper to pay a professional management company to manage your property at $80 a month, $100 a month, whatever it is, than it is for you to spend the time managing your own properties.
Yeah, I agree. There's a ton to figure out and a ton of things that can go wrong. And, you got to deal with tenants, deal with repairs, collect the rent, know the rules, know the regulations and the laws. And even if you can get through all of that and, it comes down to the end of like, how much is your time worth, and time with family or improving yourself so that you can make more money, or, whatever your hobbies are. I mean, it's just, you're paying with your time, or you're paying with money that kind of should be baked into the pro forma, of the property or of the asset. So and in a lot of states too, if you're out of state, a lot of states, actually the rule is you have to have a registered agent or someone else. So, it's different in every state, of course, but I know a lot of them sort of strongly require that. So I definitely recommend it.
Yeah. And, I'm going to take that one step further. You mentioned, having that on your pro forma, and you just made me think, two things that you definitely want on your pro forma. I mean, you're going to budget for these anyway, but a lot of investors make the mistake of skimping or omitting two things that make their numbers look better, and it makes the investment look better. But this is a mistake. And number one is, you always want to budget on your pro forma a vacancy allowance or a vacancy factor. Even though the property may be 100% occupied and you're in a great location that's occupied all the time, you still want to budget 4 or 5, even as much as 8% on the vacancy, even though it's not there, but budget for it, because in time you're going to have a turnover. Your tenant will move out, you'll have another tenant move in, and you're going to have a little bit of downtime. So budget for that. And the other thing you want to also factor in into your projections or pro formas are maintenance and repairs. And again, 4 to 5%. Or as much as 8%, depending on the age of the property and other things, other factors. But at least have 4 to 5% for vacancy, and 4 to 5% minimum for maintenance and repairs, because things will come up, things will break, things wear down, and you're going to have to deal with those. So you're being honest with yourself, and you're getting yourself a true net cash flow number when you actually factor those things in.
And it would be better in all cases to, over project what those costs will be, vacancy and repairs, and then come in under, right, and be more profitable than find yourself like taking on a deal that now is too thin and isn't cash flowing because, you didn't budget for it and project it. So that's a great point. And, kind of leads into my next question, actually, because you're providing so much value, so much education to the listeners here today. And I know a big part of what you do, a big part of your mission is to help people, educate people, train people on how to build wealth through real estate. How are you doing that specifically? Like what are the different ways people can get educated and trained by you and your team?
Well, the things we do to help educate people is what's become kind of our lead educating piece, if you will, is our podcast. I've only, I say only in quotes, I've only been doing it for five years, but our podcast, which is called Passive Real Estate Investing, is really a great resource, and it's very strategic and tactical at the same time. But it's all about information that you need as a person to invest in real estate and be successful, and what to know, what to look for, the pitfalls to avoid. But the podcast has been a great educational platform. But we do a lot of market research. We publish a lot of the information we come up with on different markets. We're not in all those markets, but we analyze a lot of markets: expensive ones, cheap ones, middle of the road ones, whatever it may be. We track 405 markets across the US, or what I call MSAs, or metropolitan statistical areas. So between our blog and the articles we publish, the downloadable free guides and reports that we publish, the upcoming book that's coming out, which is going to be given out for free. It'll be a full-size book, but I've chosen to give it away for free. The podcast interviews that we do, like on your great show here, Dan, that's really how we're reaching out and educating people. And if I'm invited to speak at events, I'll go in and speak at events. So all that, we don't charge for that education. It's just, I want to put it out there because I want people to know what they should know and avoid the mistakes that I've made, many of them costly in the past. So if I can prevent you from doing that, then it's a good thing.
And where do people go if they want to learn about these programs, or download the guides or any of the things you just mentioned?
Yeah, I appreciate you asking. So we have two websites, and everything can be found on those two. The website, the sister website, which is the home of the podcast, is passiverealestateinvesting.com. It's just all one word, passiverealestateinvesting.com, and that's the name of the podcast. The core website, the main website that we post not all, but a lot of our properties at any given time, is noradarealestate.com. Some people ask me, how do you spell Norada? Norada, noradarealestate.com. And those are the two sites where we publish and post everything.
All right. Well, before we wrap up here today, this has been great so far, by the way, Marco. But before we wrap up, I want to do the HyperFast round. Just got a couple questions for you, rapid fire, and just give us your best, quickest answer. Are you ready?
Okay.
All right. What is your biggest piece of advice to a new real estate investor?
Take action, by far. Everybody, I don't know if you want just a quick answer or if you want me to explain it, but people educate themselves and they don't pull the trigger and take action.
Yeah, I agree. You got to take action. What is the biggest challenge you've faced as a real estate investor, and how did you overcome it?
Deal flow. Sometimes you're spinning your wheels and you just don't know where to look, and that's why you want to build your team around you and do research. But if you have the right team, you'll know where to invest and find the right deals.
What's your biggest piece of advice to a seasoned real estate investor? So someone who's been doing it for a while, has done a ton of deals. Like, what would you tell that person?
Analyze how much equity you have, because that dormant, idle equity you have could be leveraged into a much larger portfolio that produces more cash flow, and it eliminates risk and increases the wealth creating potential of your portfolio.
So that's the guy who bought the properties, rented it for years. The value's gone up, mortgage has gone down, and basically get the cash out of there to do more deals.
Yeah, exactly. Some people are equity rich and cash flow poor, especially people in your market and my market here. They're sitting on a ton of equity, and the return on equity is exactly zero. So if you can redeploy that equity into other property or larger properties, you can do this tax-free, by the way. It's called a 1031 exchange. If you can reposition that equity and build your portfolio, increase your cash flow and minimize the risk, and you have no downside, why wouldn't you do that? This is something we're doing a lot right now because people have gained so much equity in some of their properties that it's the right time to actually take that equity out of harm's way and grow your portfolio and increase your cash flow.
Yeah, that's a great piece of advice. Thank you. Last one. Where do you see yourself in 10 years?
I will still be doing what I'm doing today, helping people build their real estate portfolios, creating wealth, creating passive income, putting them on the path to financial freedom. So this is what I'm passionate about and what I love to do. So I'll still be doing this.
Awesome. Marco, I enjoyed our time. You provided a ton of value. Before we sign off, I know you mentioned the 2 websites earlier, but just can you remind the listeners of that and any other way that you prefer to be contacted if people want to get in touch with you on social media or whatever your preference is there?
Yeah, I appreciate you asking again, Dan. Thank you so much. Really, just everything as far as contacting my team and myself is all on our website. So again, those 2 websites are noradarealestate.com, NORADA. And the sister website and the home of our podcast is passiverealestateinvesting.com.
All right, guys, check it out. Passiverealestateinvesting.com. And remind me the second one, Norada.
You got it. NoradaRealEstate.com.
NoradaRealEstate.com. PassiveRealEstateInvesting.com. Thank you, Marco. This has been amazing. You provided a ton of value and a ton of education, and it was exciting to have you on the show and exciting to see what you're doing and how you're helping so many other people.
Well, I appreciate you inviting me on, Dan. Thank you so much. And you too. Keep up the great work and build this podcast. I love it.
All right. Thanks a lot.
Thank you.
Hey guys, thanks for sticking around to the end. If you want to see more videos like this, click right here. And if you want 10 tips from Sunil and I on how we've built wealth through real estate, click right here to download them instantly. And if you're new to the channel, click below to subscribe and turn on post notifications so you don't miss out. And let me know in the comments what you think about the videos. I read them weekly and I pick winners at random. And I give out stuff like hats, shirts, coaching calls with me, and tickets to some of our events. I'll see you next time.